The first rule of investment is don't lose. And the second rule of investment is don't forget the first rule. And that's all the rules there are. In this video, we'll talk about how to invest if you're a beginner. Warren Buffett reveals the right way to approach and think about investing in general, as well as emphasizing some important qualities you'll need to develop as an aspiring investor. So stay focused and let's learn from one of the most well-known investors of his time, a business tycoon, philanthropist, and chairman and CEO of Berkshire Hathaway. According to Warren, the most important quality for an investment manager is the temperamental quality, not an intellectual quality. You may have the highest IQ on the planet, but in this business, what we actually need is a solid demeanor. Because this isn't a profession where you take polls. It's a business where you think. You'll need a disposition that enjoys neither being with nor against the people. The Berkshire CEO also believes in what Ben Graham would say, that you're not right or wrong because 1,000 people agree with you, and you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right. The majority of professional investors are concerned with what may happen to the stock in the next year or two. There are a variety of obscure approaches to this, but they don't consider themselves to be business owners. Warren also mentions that the real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, if they close down the stock market for 5 years. The only thing that ticker tells Buffett is the price. He'd check the pricing every now and again to see if it was incredibly low or insanely high. Prices reveal nothing about a business. Business data reveals something about a business, while the price of a stock reveals nothing about a business. We'd rather value a stock or a business without knowing the price initially, so we're not influenced by the price in deciding valuation, and then look at the price afterwards to see whether it's out of line with the value.
You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's simply an intellectual process, and the less static there is in that intellectual process, really the better off you are. What is the intellectual?
Warren also does not encourage investors to be in Wall Street by saying if he were on Wall Street, he'd probably a lot poorer. Being in Wall Street, according to Warren, you get overstimulated and you will hear lots of things that will shorten your focus. A short focus is not conducive to long profits. From where Mr. Buffett is, he can just focus on what businesses are worth. Doesn't need to be in Washington to figure out what the Washington Post newspaper is worth. And he doesn't need to be in New York to figure out what some other company is worth. It's just an intellectual process, and the less stagnant that intellectual process is, the better off you'll be. The intellectual process entails establishing your area of expertise and valuing businesses, as well as finding what sells for the lowest price in respect to value inside that area of expertise.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price and a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
Warren also admits he never bought any technology company in 30 years of investing, and he haven't understood any of them. He said it's okay, because he doesn't have to make money in every game. Every day, thousands of large American firms are offered to you at a price, and that price changes every day in the securities sector. Furthermore, you are not required to make any decisions. Nothing is imposed on you. In the business, there are no called strikes. The pitcher does nothing but stand around and hurl balls at you. And if you're playing actual baseball and the ball is between your knees and shoulders, you either swing or receive a strike. And if you're called on too many times, you're out. Not swinging would dull most people, according to Buffett, and boredom is a concern for most professional money managers. If they try to sit out an inning or two, not only do they grow agitated, but their clients start yelling from the stands, "Swing, you bum!" which is very difficult to people to accomplish. But the truth is, if you don't know enough, you don't have to swing. Warren also discusses the importance of simplicity in business and explains why not everyone gets on board. The main reason, he claims, is because the approach is so straightforward. Unlike in the academics, they focus on all kinds of variables. They focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off. Or if you buy them in election years and sell them in other years, you're better off. Or if you buy small companies, there are all these variables because the data are there and they learn how to manipulate data. Warren also quoted, "To a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way. But they aren't important." He said if he were being asked to participate in a business opportunity, it wouldn't make any difference to him whether he bought it on a Tuesday or Saturday or an election year. It's not something a businessman considers when purchasing a company. So why should you consider it while buying stocks? Because stocks are nothing more than bits of a businesses. Now what have you learned from Warren Buffett? Comment down below. Don't forget to hit the like button and subscribe. Once again, this is your Top Tech and Trades channel. Thanks for watching and see you in the next video.